Mayuresh Joshi is now joining in to take us through the last leg on the show. Mayuresh, first, share your thoughts on Tega Industry and this big, bold acquisition that they've done.
Afternoon, Rima. No, I think the acquisition is huge, and again, I think compared to the market cap of Tega at the current juncture, I think it's a huge pill to swallow in terms of the market size or the market cap itself. However, I think the permutation combinations in terms of how the business dynamics and the synergies will work around over the next few quarters and the next few years is something to be seen. Obviously, I think the management has alluded to the fact that the business is with lower margins, and therefore I think Tega's own operating margins between 2022 and the acquired business at 12.5 might mean that the management is probably a little bit more practical in terms of a 16 or a 17% margin, assuming that the 11% moves to 13% with some operational efficiencies kicking in. From a business perspective, I think it makes absolute sense because they are into the grinding media part of the business, while Tega's core business in terms of mill liners will mean a composite and a holistic solution to the end users. And therefore, I think from a business perspective, I think it should rather garner a sufficient amount of volumes across geographies. And the valuation acquisition is also pretty decent. However, I think just the sheer size and the kind of debt that they will be picking up onto their books makes me believe that you should probably watch out for the next 2 quarters in terms of how operational synergies are building in onto the balance sheets, obviously with approvals coming through. And then do the revenue synergies also start kicking in. So I think a wait and watch for us as far as Tega is concerned.
Okay, all right. Let's get in Mayuresh Joshi's view. Hi, Mayuresh. Good to see you in this afternoon. What's your view on Chola?
Hey, afternoon, Nigel. No, again, I think the management was pretty clear post last quarter's numbers that the asset quality pressures, where asset quality had clearly deteriorated, gross stage 3, net stage 3 assets quarter on quarter for the last quarter had come to 3.15, 3.2, if I'm not mistaken, 1.8 on the net stage 3. While the PCR also deteriorated quarter on quarter, close to around 44%, which makes us believe that the kind of deterioration that you probably saw translating into asset quality issues, will that come back probably in a better fashion as we head into the second half? All of us know that second quarter might be a little bit soft. And because of that, I think the kind of guidance that the management has also given for credit costs to be at 1.5% compared to 1.4% in FY25, I think that is one monitorable as well. So again, I think the management's ability to deliver healthy AUM growth, asset quality pressure coming off, obviously diversification in their product mix, and expectations that if they're able to do this in terms of 18 to 20% AUM growth, which might mean that the profitable growth might be around 25%, leading to ROAs of 2.5, ROEs of 18%, where the adjusted price to book on an FY27 basis will then land at 3.5 times. Will all depend in terms of numbers delivery. So our own sense is that we'll wait out for Q2 numbers and then expect that Q3, Q4 with GST rationalization and expectation of vehicle demand, consumer demand coming back might lead to better credit growth and reduction in asset quality issues.
By the way, speaking of GST, check out Lead Travenues Tech, Exigo, one of the stocks that has been steadily rising as a beneficiary, seen as a beneficiary, obviously, of the higher spends on travel. They, of course, run Exigo 6%, 7% today. In this week itself, it's up about 10%. And in this month, it's up almost 20%. So it's been a good going for the stock. Mayuresh, any interest? Exigo, the other one is RateGain. Anything else you like in this travel and tourism space?
So I think we continue liking hotels. Afternoon to you, Surbi. I think our own sense is that hotels as a group should continue doing well. And with the rationalization that has happened up till 7,500 odd rupees, I think that will give an impetus to the organized players compared to the unorganized players, where there was definitely an arbitrage because of the higher taxes that were getting played out. Obviously, I think the expectation in terms of end user demand expected to go significantly higher. And the strategy that a lot of these hotel players have probably strongly adopted in terms of an asset-light model, going for managed properties and being very, very selective in terms of their brownfield stroke greenfield expansion, means that leverage has not built up on their balance sheets quite significantly. And that is a boost in terms of both the margin performance as well as bottom line growth. Therefore, I think we continue liking stocks like an ITC Hotels, which we continue holding in our local and global portfolios. Even Lemon Tree as an example, which has a good mix of managed and owned properties, where expansion plans of almost 7,500 odd rooms over the next 2 to 3 years. In that mix itself, both in managed as well as owned, might mean to better EBITDA performance going forward. And that mix across their property offerings, right from entry, right to the premium side of their business, might mean that they have got a good product mix as far as their business verticals are concerned. So yeah, I think they've been very, very optimistic on the hotel space. ITC and Lemon Tree is something that we continue preferring.
Mayuresh, amongst the platform plays, which ones do you own?
Purima, honestly, none so far.
None.
But the hope here is that they might continue doing well. And I think that seems to be a base case scenario, whether it's Eternal or Swiggy. The expectation largely with festive season coming around and the hope in terms of the delivery volumes picking up quite significantly, both in terms of the quick commerce part of their business as well as the food delivery business, might mean better numbers and better volume growth as far as Q3 is concerned. Again, I think the accelerated investments that both these companies are doing in terms of their dark store openings should largely conclude over the next couple of quarters, which mean that the accelerated capex should largely be behind as we head into the next financial year. Valuations is the only thing which is of a concern to us, and therefore I think these stocks might continue doing well. But from a portfolio positioning perspective, I think we have no holdings specifically in any platform.
Okay, all right, Mayuresh, thank you very much for joining in and giving us all the advice this afternoon.
But Mayuresh, 25,000 at least, that's what we managed today. Other than that, PSU banks, that's been trending in the last couple of days. Any thoughts on PSU banking side? Do you think, we're going to again see that run-up coming in? Anything you like there?
Mayuresh, I believe you're on mute.
Sorry for that. Apologies. Afternoon, Vinny. I think the base case scenario that is getting built in is Q2 might be a sustainable quarter, which means that the kind of softness that we probably saw in Q1 might continue, but it might have some of the effects waning off, specifically when it comes to NIM compression, when it comes to CASA deterioration. And therefore, I think it can be a reset quarter for the banking stocks in general, including the PSU banking stocks that you have asked for. Having said that, I think a few of the PSU banking names had a very decent performance even in Q1. And the large part of expectations that are getting built in is that deposit growth should largely be steady for a few of these names because of the sticky base that they carry. Advances growth should come back very, very strongly with GST rationalization, consumer durable demand expected to come back, as well as private capex showing some green shoots. Provisioning for PSU banks has been exceptionally strong. And therefore, I think the kind of provisions that they're carrying on their balance sheet, any kind of recoveries and write-backs over and above that will mean a direct write-back to the bottom line, directly impacting ROEs and ROEs in a very positive fashion. So our own sense is that a few of the PSU banks were outliers. A few of the stocks outside SBI, something like a Bank of Maharashtra or a Bank of Baroda, have given decent set of numbers. And those numbers might continue improving as we head to the next few quarters.
Mayuresh, let's start with your thoughts coming in. One, for Tega Industries, how are you looking at it? Is that something that interests you? Also, Aurobindo Pharma in the pharma pack.
So, Vinny, I think for Tega, as Vamakshi appropriately explained, I think it's an acquisition far beyond their appetite at this point of time. Obviously, I think it's a very complementary kind of a business because one, I think the clients that might now come through might be more holistic in nature, grinding media, mill liners. I think it's a complete solution that Tega might be able to offer. And therefore, I think from a business perspective, going forward as the integration happens, it will be value accretive. However, I think from an immediate short-term perspective, the sheer size of acquisition is huge for Tega's appetite, and that increases the leverage component. And therefore, I think once the approvals go through, how do revenue and cost synergies play out is something that the street would like to watch out for. Because I think across geographies, having these synergies come through might take some element of time. Again, I think the key pertinent point outside this is the margin profile, and the margins will definitely come down on a consolidated basis once both these entities start reporting console numbers. However, I think with sheer volumes expected to grow up, and though I think the numbers for the acquired company is growing at 3 to 4%, I think it might be a significant value addition as far as revenues are concerned. So in our opinion, I think let's wait and watch in terms of how these synergies play out. Not taking a very bold call on Tega Industries at this juncture. For Aurobindo in particular that you ask, I think the expectations in terms of how revenues will grow ex Revlimid is going to be extremely critical. Aurobindo believes that they can launch their own first biosimilar by the end of FY26. They still believe that the EBITDA band can be between 20 and 21%. And ex-US, I think the expectation in terms of revenue growth is something to be watched out for. So these are the pointers that will probably play out for Aurobindo Pharma as far as the core business is concerned. And therefore, I think it's very, very critical that Q2 numbers come out to be reasonably better for some element of re-rating onto these stocks. So we'll be closely watching out for Q2 numbers for